Hey ACU students, welcome to week 6 of Business and Accounting 222. This week we're looking at a number of objectives. We're going to look at how to account for the disposal of depreciable assets. This is out of chapter 10. If you remember last week we looked on the first part of chapter 10, a number of topics related to understanding how to account for depreciable assets. So this week we're looking at some like what happens when you dispose of them, get rid of them. We're going to look at issues related to accounting for natural resources and also kind of tied to that some of the how to account for the intangible assets that a company or corporation might have, things like research, trademarks, etc. Then we're also going to look at the impact of acquiring and financing long-term assets. How's that done? And again, we're going to touch on, like we did last week, the ethics portion of that too. So, all right. So when plant assets, things like buildings, equipment that you might purchase, that include your vehicles and that sort of thing, when they're no longer useful, you have to get rid of them. And you can get rid of them 3 different ways. You can, discard them, just like junk them out. You can sell them, or you can trade up. Kind of like how you do with a car. Sometimes you take your used car that you purchase, you sell it, you kind of trade up if you can, or at least use it as a down payment. Same thing with company assets. So regardless of how a company disposes of their assets, it has to be recorded as a depreciation expense for the year that you do that. If an asset remains in use beyond its estimated life, then it's really its costs and accumulated depreciation remain in the ledger account. So the longer you hang on to an asset, the longer it just lingers on your ledger account, and you have to account for it. If the residual value goes down to 0, the carrying value of a fully depreciated asset is 0. And then if it's discarded, it's either discarded at no gain or loss. But for assets with a carrying value, so a loss equal to the carrying value should be recorded. So again, when you're getting rid of these assets at your plants or in your offices, you have to account for what happens to them. You can't just sell them and pretend and then not do anything with the money or the carrying value. So exchanges may involve similar assets. Now that's another way, like I said, trading up on vehicles, trading up on old machines. The purchase price, if the purchase price is reduced by the amount of the trade-in allowance. So if the trade-in is greater than the asset's carrying value, then you realize again, if the allowance that you get for your trade-in is less than the carrying value, then it's a loss to the owner. Natural resources, if you recall from last week, natural resources are a long-term asset, and it's not called depreciation, it's called depletion. Depletion cost per unit is actually how it's measured. Again, it's the cost of that natural resource minus any residual value that's calculated, and then divided into that is the number of usable estimated units that you have left in that. And that gives you a depletion cost per unit. Let's talk quickly about these intangible assets that many companies carry. In fact, all companies have some form of these. There's copyrights, there's patents, there's these things called, this leasehold software, trademarks, and that sort of thing, and even goodwill is another one of those. Oddly enough, your customer list could also be something that's an intangible asset that you may want to consider. In our company recently, we started doing a video podcast. We do it once a month, and it's called the Saber Brief, and it only goes to our customers, but we consider it an asset. Now, we have not categorized it yet on our balance sheet, but it's something that we could do as a long-term asset. It's trademarked. It's part of our branding. This graph shows often what larger companies will do in terms of how they categorize these intangible assets. Intangible assets are accounted for at the amount that a company paid for them if it's something you purchased, and it should be included on your balance sheet. The useful life of an intangible asset is the period over which the asset is expected to contribute to the company's future value and their future cash flow. That may be, an definite time or even an indefinite time. R&D costs. The R&D costs generally show up as, let me see if I get, yeah, they're charged to the expense on the expense side of the P&L or the income statement. And when it turns into an actual product is when it turns into an asset. So the cost that companies incur in developing, for example, computer software, that cost is charged as an expense on the income statement. And once that software product's developed, it's feasible, it's sellable, then it's recorded as an asset. Goodwill, again, we talked about that. These are all different categories of goodwill. Some of them are community related, some of them, even manufacturing efficiency could be considered a tangible asset. And the Financial Accounting Standards Board says that, hey, requires a purchase goodwill be reported. If it's a purchase goodwill, it can be reported as a separate line item on the balance sheet, and it's going to be reviewed annually for how it's affecting your company. And a company should record goodwill only when it acquires a controlling interest in another business. So, all right, management decisions relating to long-term assets. This gets into a little bit of cash flow as well as ethics. So, although some companies are profitable enough to pay for their own long-term assets, most of us have to finance that. Information about acquisition of long-term assets appears in the investing activities on your statement of cash flows. I think it was chapter 3. Go back to chapter 2 maybe, I don't remember now, and look at the statement of cash flows, and you'll see on there investing activities to finance long-term or to finance acquisition is one of the cash flow items. So free cash flow, there's this idea of free cash flow. So cash flow is one thing, but what's left over in terms of cash after everything else is subtracted out? So if you take this pile of cash that you may have available to you, after you subtract out operations, interest, dividends, payments on capital expenditures, the amount of cash that's left over is considered this notion of free cash flow. And with free cash flow, positive free cash flow means that you can go out and you can finance something yourself. You can pay down debt with it. You can do a lot of things, just like your home finances. If you have money left over at the end of the week or end of the month, what are you going to do with that cash? You're going to save it. You're going to pay down debt, that sort of thing. If it's negative cash flow, not good. So you can survive on negative cash flow for a little bit of time, but eventually your savings gets eaten up. And if you can't borrow money and you can't issue stock, you could eventually turn into not a viable interest any longer. When a company acquires a long-term asset, it defers some of those asset costs to later periods. Again, we're going to talk about ethics. To avoid fraudulent reporting of assets, a company's management must apply some accrual accounting principles to the amount of the total cost of the asset and then the amount to retain on the balance sheet. Remember, I think we talked about last week or the week before, a lot of room for subjectivity in this area and therefore a lot of room for fraudulent behavior. I think your book mentions WorldCom as one of the examples that took advantage of this, didn't work out so well for them. 4 important questions that we have to ask then when we talk about how we're going to take care of our long-term assets and from an ethics perspective. That's how is the cost of a long-term asset going to be determined? Especially this area of goodwill, some of those intangibles. Be very careful about that in terms of determining the long-term asset, the cost of that long-term asset. I wouldn't overstate it. Okay. How should the expired portion of the cost of the long-term asset be allocated against revenues over time? So how fast are you going to bleed off the value of that? Especially what that question is asking. How should subsequent expenditures like repairs, maintenance, improvements to the asset, how should those be treated? And then how should you dispose of those assets? So all questions to answer when it comes to figuring out how to handle these long-term assets. Okay, listen, finish up chapter 10 this week and make sure you're on time with all your submissions. We're not quite to the halfway point, but you guys are doing great. Hang in there. And remember, give me a call whenever something comes up. And remember, God is on his throne. He's always been there. He's always going to be. Have a great week, you guys.